Hi everyone, thank you for tuning in tonight. It's good to see you again. I'm James, market strategist at uSMART Securities. Welcome to Talk Stock with James series. Tonight we are talking about Meituan. Meituan has not been doing well for the past 2 years. Is there more pain or more gain ahead? We are also conducting this Talk Stock with James series every alternate Thursday, 7:30 p.m. The next one would be 22nd of June. I haven't decided what company I will be discussing yet, but it will likely be either Pinduoduo or Starbucks. So stay tuned for further updates. And tomorrow we will kickstart our US option series. Our first seminar topic is basics of options investing. My fellow colleague Kevin will be the speaker. He is an options expert. Please give him your support by attending. Unlike me, I'm more of a stock guy. I will share the webinar link in the Q&A box. If you are interested, please register for the session. And if you are interested in listening to the replay of this Meituan webinar after it ends, or if you would like to access to our previous webinars, please visit the Talk Stock with James channel on YouTube. I will be uploading the replay video for this webinar over the weekend. I will also be conducting a basics of investing webinar organized by SGX tomorrow. If you are interested in attending, please find the registration link in the chat box of this Zoom webinar. I will be sharing about investing 101 on stocks, REITs, and ETF. Additionally, uSMART Securities will be participating in this year's Invest Fair organized by Share Investor. It will be a physical event, and I will be speaking at this event as well, and I will provide you with more details once everything is finalized. Let me begin with some disclaimer first. This presentation is presented to you for education and sharing purpose only and does not constitute to any form of advice. Past performance is not indicative of the future performance. Okay, let's talk about Meituan. Meituan is one of my favorite Asian tech stocks alongside TSMC, C Limited, and Tencent. However, it's unfortunate that even good companies can experience a decline in share prices. In the case of Meituan, its share price has been decreasing for over 2 years now. Therefore, today, let's analyze, is now a good time to start investing in Meituan. So what is Meituan? It is China's leading food delivery platform. You can think of it as the China version of Food Panda or GrabFood. Oftentimes, Meituan boasted an average delivery time of 30 minutes. Meituan went public in September 2018 at an IPO price of 69 Hong Kong dollars per share, and it went to $460 in 2021, benefiting from COVID. However, since then, at its worst, the share price has plunged 77% to 103 Hong Kong dollars. And the current price is about 123 Hong Kong dollars. This is slightly above the pre-COVID high of 116 Hong Kong dollars. So the current share price looks quite attractive, considering it's still about 73% below its all-time high. In 2023, market has not been kind to Meituan as well. The year-to-date performance for Meituan is negative 30%, making it the second worst performer among Chinese technology stocks. JD.com is the worst performer with negative 33% this year. In comparison, Alibaba returned negative 3%, Tencent returned 5% year-to-date, and Pinduoduo is negative 11%. Therefore, you can't really blame the decline of Meituan to the general market conditions, as there are other companies that have performed decently this year. So what about the fundamental side of things? Is the revenue growth of Meituan worse than other Chinese technology stocks? The short answer for that is no. Meituan's revenue growth is actually stronger than other Chinese technology stocks. It stands out as having the most exciting growth among all. For example, in the first quarter 2023, the year-on-year revenue growth for Meituan is 27%. In comparison, Alibaba revenue growth is just 2%. Tencent is 11%. Xiaomi is negative 19%. JD.com is 1%. And Pinduoduo has the best revenue growth of 58% year-on-year. And if we look at the estimated revenue growth for the entire year of 2023, Meituan is projected to have a growth rate of 26%, outperforming Alibaba 8%, Tencent 13% as well. So what went wrong? I would say the short answer to that is Meituan has the highest valuations, highest multiples among Chinese technology names. Market participants might be thinking that share price of Meituan has not come down low enough to justify the high multiples such as the PE ratio. For example, Meituan PE ratio is 296 times, whereas Alibaba is just 13 times, Tencent is 15 times, and Pinduoduo, which enjoys higher revenue growth, has a PE ratio of 79 times. This is still substantially lower than Meituan's PE ratio. So I guess if you are one of those traditional value investor, you might be put off by the high multiples and not interested in investing in Meituan. However, if you are a growth investor, let me share more about Meituan and why it deserves a high multiple, as well as why you should consider investing in Meituan. In fact, analysts have assigned a high target price for Meituan. According to Bloomberg consensus, out of 62 analysts, 59 recommend buying the stocks, 2 recommend holding it, and 1 recommends selling it. Yesterday, closing price was about $123. The 12 months target price is 199.97 Hong Kong dollar, indicating an upside potential of 61%. So let me dive deeply into Meituan. Meituan is mostly known for its food delivery service in China. It is currently the largest food delivery player with a market share of 69.4%. Ele.me, which is a subsidiary of Alibaba, takes the second place with a market share of 23.6%. Together, they command a combined market share of 90%. But Meituan is so much more than that. It is an all-in-one online service application that allows customers like you to access multiple services at their fingertips. You can think of Meituan as a combination of many companies, including Foodpanda, Uber, Coupon, Citybike, Booking.com, Airbnb, Yap, Shopee, and TaskRabbit. Meituan is a super app that offers a wide range of services that aims to fulfill most of your local consumption needs using just one app in China. You can also use Meituan app in countries other than China, such as Singapore, Japan, Malaysia, Korea, and Europe. But the app itself mostly serves as a restaurant review site like Yap, a tour and attraction booking platform like Klook, and a hotel booking platform like Agoda. And it is only available in Chinese language. This is why many Singapore investors have limited understanding of Meituan, since its main operations are concentrated in China itself. And it mainly serves the consumption needs of China's citizens when they go overseas, when they were to use the Meituan app overseas. Nowadays, Meituan in China have shifted their focus from being just a food delivery platform to adopting a retail plus technology strategy, which emphasizes on retail business like grocery. However, the mission statement remain the same: to help people eat better and live better. Basically, Meituan wants to take care of all the 吃喝玩乐 side of things. The app itself is an all-encompassing platform for local services that include everything from eat, drink, play, and entertainment. I strongly recommend you to download the Meituan app from the App Store to gain a better understanding of Meituan. So I asked my fellow colleague to try to use the app itself, but he doesn't like it. He feels that it's too cluttered. Here are some of the services that Meituan provides. Although there are many more, I don't want to overwhelm you with too much information because it can be confusing for me as well. To put it simply, Meituan is a local live platform that offers more than 200 services. You may ask, why Meituan wants to provide so many services? The reason is that it aims to become a super app by offering essential services for everyday needs. Meituan wants to become the go-to platform for users by providing convenient services like food delivery, group buying, travel booking, and many entertainment options. The logic behind this is, while you may mostly use Meituan for the takeout service, for the food delivery service, which is a high frequency need, they also want to showcase you the other services that they offer. So next time, when you require a low frequency service such as hotel booking, you will remember that Meituan provides it. This way, you won't have to search for another app to download it. Meituan's main goal is to lead customers who use their food delivery service towards using their additional range of services. Let's discuss the factor that contributed to Meituan's success. Meituan's success can be attributed to many factors. Firstly, the company capitalized on the advancements of location-based services, LBS. To put it simply, LBS is similar to GPS, which allowed Meituan to offer efficient delivery services, optimize the route planning, to provide real-time updates on delivery orders, and customers have the capability to precisely locate merchants, such as finding restaurants that is running promotions within 100-meter radius. Secondly, Meituan is trying to establish an ecosystem that encompasses a wide range of services that enable cross promotion, cross selling, and improve customer retention. Essentially, Meituan aims to integrate itself into your everyday life, encouraging you to use their services as frequently as possible. This is why it offers a wide variety of services, even though not all of them are profitable. Its goal is to keep you within the ecosystem and cultivate a habit of using the app extensively. Gradually, you will not only relying it on the food delivery, but also for purchasing movie tickets and spending on other offerings as well. And to achieve this, Meituan is trying to onboard as many merchants as possible to create a network effect. Thirdly, and probably the most important factor, is the CEO Wang Xing. He has played a crucial role in Meituan's success, making him one of the world-class CEO in my opinion. Wang Xing is one of the best Chinese CEO, and he is just 44 years old. Allow me to share with you a few business decisions he made to demonstrate his capability. Let me take some time to share with you how good it is. First of all, Wang Xing is best known for leading Meituan to break out in the 1,000 coupon war. In Chinese, it's called 千团大战. What happened is there were more than 5,000 coupon companies at its peak in 2011. It was unsurprising because coupon business model was relatively low tech and could be easily replicated itself. However, Meituan was the only survivor among all its competitors during their period, the coupon industry operated on a cash-burning business model, with each company subsidizing the merchants to offer greater discounts and investing heavily in advertising. In contrast, Meituan chose to prioritize the development of a mobile app and establish many physical stores across China to onboard more merchants to the platform. And one thing that Meituan did correctly is that it avoided making big changes. A lot of competitors at that time shifted their focus from group buying of services to group buying of goods back then. But Meituan did not follow, because Wang Xing is aware that if Alibaba decided to launch a group buying platform for goods, it would likely eliminate all the competitors. And Alibaba eventually launched a group buying platform for goods, which helped Meituan in killing all the coupon competitors. In essence, the competitors burn so much cash until they burn themselves. After winning the coupon war, Meituan also realized that coupon business will not make good money for Meituan. So Meituan quickly expanded into food delivery service, whereas Ele.me had already been there operating for 5 years. However, Wang Xing believed that Ele.me was overly focused on Tier 1 cities, which had the highest spending power, but also faced intense competition. Everyone wants in the Tier 1 cities. Meituan, on the other hand, aims to target not only Tier 1 cities, but place greater emphasis on Tier 2 and Tier 3 cities, and even venture into Tier 4, Tier 5, Tier 6 cities for takeout services. By allocating more services, more resources to the lower tier cities, Meituan achieved success and became the market leader in the food delivery services. And if you study Meituan's other business ventures, you can also observe a recurring pattern where Meituan is not always the first company to enter a market, yet Meituan managed to secure a significant market share or becoming the market leader despite being the latecomer. Examples include coupon, movie ticketing, hotel booking, food delivery, and attraction booking itself. Lastly, I want to talk about Dianping, a China version of Yap itself. In 2015, Dianping and Meituan announced a merger. Meituan was renamed to Meituan Dianping. Initially, the company was co-CEO and co-chaired by the existing CEO of Meituan, Wang Xing, and existing CEO of Dianping, Zhang Tao. However, 1 month later, Zhang Tao was forced out of the company. Subsequently, over the following years, all the management from Dianping was gradually forced out of the organization. And in 2018, when Meituan Dianping went public, Meituan Dianping was officially renamed to simply Meituan that you see today. And now, when we look back at the story itself, it looked more like it probably looked like a merger on surface. Wang Xing probably portrayed a beautiful merger story to attract Dianping to merge, but indeed it's an acquisition. All in all, I strongly believe that if Wang Xing continues to serve as CEO, he will lead Meituan to even greater heights. Now let's look at the financial statement. Meituan has 3 main business segments: food delivery, in-store hotel and travel, and new initiative. However, it has since changed the reporting format to core local commerce and new initiative. In the new reporting format, the food deliveries, in-store, and hotel now belong to the core local commerce itself. And they also take part of the segment that previously belonged to new initiative and group it here, which are Meituan instant shopping, accommodations, and transportation ticketing itself. And now the brand new initiative include Meituan Select, Meituan Grocery, B2B food distribution, ride sharing, power bank, restaurant management system itself. So in the past, you would know the growth rate of food delivery, in-store, hotel and travel, and new initiative. And you are able to know the take rate for each segment. And they also disclose the GMV, and they also disclose the number of online transactions as well. So analysts like me could use this number to make good assumption for DCF model and come up with a fair value. But nowadays, since there is no clear breakdown, they do not disclose GMV anymore, for example, that makes it harder to come up with a good valuations model. So why Meituan wants to change the reporting format and report less things? It is all because of common prosperity. For example, Meituan playbook all along is to monopolize every segment that it venture into. Because if Meituan were to gain large enough market share, Meituan can start charging higher commission. And as an investor, you want to see the take rate going higher and higher. But China government is not comfortable that Meituan were to grow too big to monopolize the industry, earn too much money from the merchant, and exploit the rider and the customers. That's why Meituan needs to mask the earnings, make it looks as complicated as possible to avoid more fine, more penalty from China government. But the side effect is that analysts or investors could not fully understand the growth. And if they are not able to understand, Meituan probably doesn't deserve a high valuations, high multiple. And since nowadays every financial data is not attainable, one of the meaningful number is the number of online transaction itself. The number of online transactions show it grew 13% from 15 billion in 2021 to 17 billion in 2022. But still, you do not know how much of this belong to food delivery or others. By looking at the financial data, you will have a general feeling that Meituan is doing okay. Revenue growth for each new regroup segment is growing. For example, the year-on-year growth in Q1 2023 for core local commerce is 25%. New initiative is 30%. Operating income for every segment improved as well. And that's it. You won't gain a lot of insights looking into it. As there is no clear breakdown of things for you to analyze, I think the more meaningful way to look at the financial data is just looking at the revenue growth, operating income. To put it simply, as long as the revenue growth rate is okay, the operating loss is improving, operating margin is improving, then I think Meituan is doing okay. This is what we hope to see, and this is exactly what we are seeing now. If we were to look at the quarterly data, we are seeing that it's still maintaining above 20% year-on-year growth, and the operating in the recent quarters, and the operating income has turned positive in the latest quarter at 3.5 billion as well, and the operating margin is also improving. Investing in Meituan requires you to look at the industry landscape. The China retail e-commerce penetration rate is at 45% for China now, and it tells you that it can improve further. But for individual segment, a lot of them now are below 20%, indicating good growth opportunities. So basically, Meituan is trying to venture into all this local live service sector itself. And basically, all these individual live service sectors will have better penetration rate in future. In terms of the in-store GTV, gross transaction value, Meituan is currently owning the largest market share at 62%, but in 2025, it's expected that Meituan will own only just 44%. Still the market leader, but that's okay. Because even with lesser market share, I personally expect that Meituan may be the profitable company in the in-store segment itself. So what is interesting here is that Douyin is expected to become the second largest player with 20% market share by 2025. I think the rationale is Douyin has more than 700 million active users now, higher than Meituan, 678 million users. So since Douyin can capture more user attention and engagement, it has the potential to convert more customers as well. However, I'm not overly worried about Douyin at the moment because the user profile of the two platforms are different. In short, most Meituan uses the app in anticipation of completing a transaction, but most Douyin uses the app in anticipation of receiving some form of entertainment. Let me quickly go through some of the downside risks of investing in Meituan. Firstly, there is He-Man risk. In May 2021, Wang Xing posted a poem in his social media platform Weibo, which investors interpreted as criticizing President Xi. Following this incident, Wang Xing took down the post and locked down his social media, and now he has since kept a low profile. However, since then, I have been constantly worried about that Wang Xing might face the similar destiny like Jack Ma. I admire Wang Xing a lot, that I reckon Meituan will not continue to do well without Wang Xing. Secondly, all the business venture that Meituan is in now face intense competition. For example, there is heightening competition in e-commerce. Each player is offering large subsidy to gain market share, and Meituan is not making a dent in the e-commerce segment. Meituan market share should be lesser than 1%. And in terms of food delivery business, the largest business revenue contributor to Meituan itself, lately you are seeing that Douyin also expanded into food delivery and local live services segment. Douyin basically allows merchants to attract food order via short videos or live streams. We can only hope that the food delivery business has higher requirement for logistic efficiency, which is currently the weakest link for Douyin, and will have an impact on users' shopping experience. To compete against Douyin, Meituan has launched its own live streaming app called Meituan Zhibo. All in all, Meituan's focus is now local live services segment, which Alibaba, Douyin, JD.com, Pinduoduo are all competing in it. And I think this is part of the reason Meituan debuted in Hong Kong last month. It launches food delivery brand Kita, and currently Foodpanda holds a dominant market share of 64% in Hong Kong, whereas Deliveroo accounts for the remaining 36% itself. But still, it appears to be a favorable market for Meituan to enter into Hong Kong. The revenue in the meal delivery segment is projected to reach 0.87 billion USD in 2023 with a compound annual growth rate of 4.34% from 2023 to 2027, while China has a 49% online takeout penetration rate last year. Hong Kong penetration rate is just 39%, indicating ample room for growth in Hong Kong market. Another significant risk for Meituan is that the regulatory environment in China and Meituan simply has no control over. Previously, Beijing fines Meituan 534 million USD over abuses such as pick one from two over his monopolistic behavior. And Beijing also criticized Meituan's big data queuing behavior, which basically charges higher fees for old user, for frequent user itself. And Chinese government has also demanded that Meituan is to ensure minimum pay and provide insurance coverage for the delivery riders to adhere to the concept of common prosperity. And let's talk about Meituan past performance. It enjoyed triple-digit returns, 132% in 2019, 189% in 2020. However, it returned negative 23% in 2021, negative 22% in 2022, and this year look like the return will not do well as well. But other ATMSJ plus Pinduoduo are also not doing good this year as well. And if we were to look at 4-year annualized return, we could see that it is 19% for Meituan, actually outperforming most of the other Chinese technology stocks, except for Pinduoduo. Pinduoduo is 39% for 4-year annualized return. And if we were to take maximum drawdown and standard deviations into considerations, Meituan risk to reward may not be as good as US tech stocks like Apple or even Nasdaq 100. All in all, as an investor yourself, you are not required to invest in Hong Kong tech stock. You can invest in any stock in the world. Personally thinking, some of the US tech stocks like Apple has a better risk reward. But if you really want to gain exposure to China growth, Meituan will be one of your top choices. Let's talk about valuations. We use DCF model to derive a fair value of 210.53 Hong Kong dollar for Meituan share. So if you compare it to the yesterday closing price at 123.5 Hong Kong dollars, it represents an upside potential of 70%. Some assumptions I made include a WACC of 19.5% for Meituan and a terminal growth rate of 17%. And I also assume that Meituan will continue to enjoy good growth opportunities in most of the market it ventures into. Let me use technical analysis to share with you if now a good entry price for Meituan. There are two important things I would like to show you here. Firstly, we like to use Fibonacci extension to check if Meituan has hit its bottom. So I draw an extension from the all-time high to the 2021 bottom and extend it by another 27.2%. Then I will get a 107.9 support level. For those who study Elliott wave, you will recognize that 127.2% is a strong extension move. So we have some good price reactions here at 107.9, which every time it touches this, it will rebound. So for those who are long-term investors, I reckon this is a good entry price to accumulate. And for those who are short-term traders, for trading purpose, you may consider to long at current price, but to cut loss when it break below the support level at 107.9 or below the low here. Secondly, I would like to use Fibonacci sequence to see if when it will pivot. Some of the previous low that we see are actually coincide with Fibonacci sequence. For example, the high here is 35 weeks apart from the all-time high, which is a number of Fibonacci sequence. And the low over here is 56 weeks apart from the all-time high, which is again a number from Fibonacci sequence. The subsequent low here is 88 weeks apart from the all-time high, and the next Fibonacci sequence is 144, which fall on the week of 20th November 2023. So what it means is that in the week of 20 November 2023, the share price will pivot. Maybe the share price will hit the bottom, then it will pivot, or more likely, I would say that share price may start to rise from here, from now and until the week of 20th November and start to pivot itself. All in all, I think Meituan is one of the best Asian technology stocks out there. As long as Meituan stays as the market leader in the food deliveries business, which is a high frequency consumption, they will still be able to cross-sell many other services to their customer. But again, considering all the risks I mentioned earlier, and I could never be physically present in China full-time to fully understand the China market landscape, I would say that it deserves a 3 to 5% weight in one's portfolio for long-term investment if you want to partake in China's growth. Meituan is one of the best companies to participate in China growing consumption. I think Meituan is worth revisiting in the near future, that it could probably deserve a higher weight once China economy number recover more, when it really exceeding market expectations. I would say Meituan probably deserve a higher weight, like 5 to 7% in the future. Meituan is currently listed on the Hong Kong Stock Exchange. However, you can, when you search Meituan on our app, uSMART Security app, you will realize that Meituan share also traded on the US OTC market as well. You may be tempted to trade the share listed on US OTC. Personally, I'm not interested in them because they are having low trading volume. As we can see, the trading volume for this is only 1,000 shares, and this trading volume is only 500,000 shares respectively. So it's always recommended to invest in Meituan listed in the Hong Kong Stock Exchange. The main drawback is it is traded on, it's traded in Hong Kong dollars, which Hong Kong dollar may not be your preferred trading currency. On the side note, it costs more to own one lot of Meituan compared to the US OTC market, approximately 2,100 Sing dollar to own 100 shares of Meituan. And I shall end my presentation here. Please subscribe to my channel, Talk Stock with James on YouTube, and I'll be uploading this webinar soon. And let's now proceed to the Q&A sessions. Please take your time to type your questions in the Q&A box, and we'll try to answer all your questions. Okay, first question. What do you think of Apple after the Vision Pro announcement? I have not done a deep dive into the product itself, but after all, it is an Apple product. So whatever product Apple launches, people are just going to buy it. Some analysts are quite optimistic that it will contribute to about 10% of the total revenue in the future, which I think it is possible if they were to drop the price in future. But I also reckon that launching at such a steep price at 3,500 USD indicates that this kind of VR, AR headset is not ready for prime time yet. that it probably belongs to the early adopter, but the technology itself is not ready for mass market. So if you are thinking about investing in Apple, Vision Pro should not be your main consideration. Okay, this is a good question as well. What other stocks could benefit from Apple Vision Pro? I would say since Apple forms partnership with Unity to bring the app to Vision Pro, and you can also use Vision Pro to stream Disney content. So these two companies, Unity and Disney, could be some of the stock that could benefit from the launch of the Vision Pro headset. But I think that it is worth studying that how many users will that be for such an expensive headset at 3,500. If there is not much user, then I don't think Unity and Disney will benefit a lot from it. And Vision Pro ultimately will only launch early next year, so it's too early to tell. And I like to remind you that some of these Apple concept stocks like Disney and Unity also got their own set of problems as well, like their business model and their revenue growth. So all in all, what I like to say here is that you should not invest in this company because of Vision Pro. To me, the most direct beneficiary out of this launch is still Apple. Okay, is it time to invest in Hong Kong stocks or index now? I would say that second half would be better for Hang Seng Index. I would say that the pessimism about China economic recovery is overblown. And I do see that Hong Kong stocks lag US stocks, US indices a lot so far this year. So there should be some catch up in play. But if your question is, will Hang Seng Index outperform US indices by the end of this year? My answer for that is no. I would say that you still probably need to own more US stocks relative to Hong Kong stocks or other Asian stocks in mid to long term itself. So is now a good time to invest in Hong Kong stocks? Yes, but please look out at your position sizing. Any opinion on CrowdStrike? Okay, unfortunately, I don't have. Okay, I haven't gotten enough time to study the cybersecurity market that to make an investment case about that itself. But I guess fund managers will usually invest in CrowdStrike or Palo Alto. So these are some of the popular names that you are interested. If you are interested, I would say that if you do not understand much about the company itself, you can just invest in the cybersecurity ETF like CIBR, if I'm not mistaken. So I repeat, the ticker code should be CIBR ETF itself. Okay, will China government break out Meituan like Alibaba? To be honest, I do not know the answer. I would say it's a possibility, but I personally don't think that is a need to break out Meituan itself, because everyone probably know that the main business is still food delivery, and other business segment are not doing so well, or in the past many years, investors really do not know which segment exactly is doing great itself. So if Meituan were to break out, split out some of the sectors itself, right, to go listed, or I don't think it's worthwhile for them to do it, and I don't think they got the intention of doing it itself. Okay, what do you think is the reason for Meituan's price action so far this year? What is the main concern beside geopolitical reason? Geopolitical reason definitely is a reason, and some of the reasons I mentioned as well, which is the intense competitions. And probably one thing to take note is that because Meituan is venturing into the local life services segment. So this segment itself, right, is very much aligned with the economic cycle. So if the China economy is not doing great, then people expectations of the total addressable market for this segment may not be too well as well. So I would say that probably a lot of investor or analysts try to give a lower GMV for all this total addressable market, and this causes people to rethink that, oh, Meituan valuation itself is too high, probably the share price need to come down itself. But all in all, I would say that I still think that in terms of local consumption business segment, the total addressable market, China is still one of the fast-growing one that I would say that Meituan is in the one of the better segment, better market. Okay, so just now, what is the entry price to enter for long-term investor? I would say that at the current share price, it probably is worthwhile for long-term investment itself. So the thing about entering over here is that I would say that its valuation is fair. My DCF model tells me a upside target of 70%, and I also think that you should control your position sizing. So if you think that you don't want to take too much risk in Meituan, probably just 1% of your portfolio. But I would say that 3 to 5% is probably good to have if you really want to gain exposure in the China local consumption growth itself. Okay, I think this is the last question. How come Zoom is still lower than the COVID level? I am holding on to some of the Zoom shares. Any recommendations? I don't think Zoom is a bad company. I haven't gotten chance to do a DCF model on Zoom to see how high it could go. But based on the Bloomberg consensus, if I remember correctly, the target price should be $80-something, which I think the current share price now may not be worthwhile for investing in Zoom, because you probably will be taking too much risk. I would say the target price is upside potential is probably not good enough for me to my liking. I would say that Zoom may be worthwhile to invest in the future when there is more market breadth in the US equity market, because at this moment, we could only see that large cap technology stocks are being pushed up by investors, but smaller cap technology stocks are not in favor at the moment, are not in fashion, but I would say that it will be favor again one day. But again, the keyword here is that do not take too much risk in the smaller cap technology stocks. It's better to invest in large cap technology stock first and gain large enough positions, then invest relatively smaller positions into the smaller cap stocks like Zoom. Okay. Yep, I think this would be all the questions. And we have also run out of time. Thank you all, and I shall see you next time. Thank you.